For years, if you wanted to invest in Kenya, it was pretty simple. You bought stocks. But that's all changed. The Nairobi Securities Exchange isn't just a stock market anymore. A whole new set of powerful investment tools has shown up, and they are completely rewriting the rules of the game. So the big question is, how do you play to win in this new environment? Well, stick around, because we're about to break it all down and give you a clear, simple playbook for investing in Kenya today. So here's our game plan. First, we're going to survey the new investment battlefield in Kenya to see what changed so fast. Then we'll get into the main event, the classic stocks versus these new special funds. We'll pit them against each other in the wild 2025 bull market, uncover some really important hidden rules about taxes, and then, finally, we'll put it all together into your personal strategic playbook. All right, so let's set the stage. For the longest time, the path for investors was pretty straightforward. But now, the NSC has become this sophisticated, multi-asset battlefield. And this wasn't some slow, gradual shift. Nope, it was a huge change triggered by some really dramatic economic events that basically remade the entire market. I mean, talk about a roller coaster. The last decade has been pure whiplash for investors. You had the peak back in 2015, followed by a pretty brutal crash that bottomed out in 2023. But then, boom, an absolutely explosive comeback, with the market rocketing to almost 3 trillion shillings. You can bet that this crazy ride made a lot of investors think, whoa, maybe putting all my eggs in the stock basket isn't the smartest move. It forced everyone to start looking for better, more structured alternatives. So what was the spark? What lit the fuse for that massive 2025 explosion? It all comes down to this one number right here. The Central Bank of Kenya came in and slashed interest rates by a whopping 225 basis points. And just like that, those super safe but kind of low-yielding government bonds started to look, well, boring. A tidal wave of cash came rushing out of safety and started hunting for much bigger returns in the market. And that brings us to the core dilemma for every investor today. It's a fork in the road. Do you stick to the classic path and buy individual stocks? Or do you take the new path and explore these professionally managed special funds? The right answer for you really depends on understanding how these two things are built. They're fundamentally different. Okay, so buying stocks directly is simple, right? You buy a piece of a company and you're in the driver's seat. All the potential profit is yours, but so is all the risk. You're flying solo. Special funds, on the other hand, are engineered for security. Yes, they're a little more complex, but that complexity serves one purpose and one purpose only, to protect your money with multiple layers of oversight. Honestly, the best way to think about a special fund is as a financial fortress. It's a brilliant analogy. The entire structure is built to separate the key jobs. The person making the investment decisions is kept completely separate from the person who actually holds the assets. That design makes it incredibly hard for things to go sideways. Inside this fortress, you have 4 guardians, each with a very specific role. You've got the manager, they're the brains, making the investment calls, but they can't actually touch the money. Then there's the custodian, who acts like the vault, physically safeguarding all the assets. The trustee is like the sheriff. They're the legal owner, a powerful watchdog making sure the manager plays by the rules. And finally, you have the sponsor, the one who puts up their own money first to prove they have skin in the game. It's a whole system of checks and balances. So what's on the menu with these new challengers? Well, you have real estate investment trusts, or REITs, which are a super easy way to get into the property market. Then there are exchange-traded funds, ETFs, which let you invest in almost anything, gold, global stocks, you name it, with just a single click. And then you have the heavy hitters, AIFs, which are high-stakes private funds for the really serious players. Now that we know who the players are, let's get to the fun part. How did they actually do when the market was on fire in 2025? We're going to put them head-to-head, and I gotta say, the winner might not be who you think it is. Just look at these numbers. The stock market had an incredible year, with the NSE 200 index soaring over 56%. I mean, that's a fantastic return. But then you look at the gold ETF. It delivered a jaw-dropping 70.4%. It didn't just beat the market, it absolutely smoked it. It proved that the biggest gains weren't always in local stocks. But hold on. Chasing explosive growth isn't the only way to invest. For a lot of us, a steady, reliable income is way more important. And frankly, the wild swings of the stock market can be pretty nerve-wracking. This is where another one of these special funds really starts to shine. Take a look at the Acorn iREIT, which invests in student housing. I love this example. Think of its returns like a fruit tree. Every year, you get the fruit. That's the 4% income stream that gets paid out to you. But at the same time, the tree itself is growing bigger and more valuable. That's the 10% increase in the property value. So you get both a steady income and growth. It's the best of both worlds. Okay, but those big return numbers we've been looking at, they're only half the story. The number that really matters is how much money you actually get to keep after the tax man takes his cut. And this, my friends, is where the hidden rules of the game can completely change your final score. All right, lean in for this one, because this is the one secret every Kenyan investor needs to know. If you own stocks directly, you get hit with a double whammy of taxes, 30% at the company level, and then another 15% on your gains. But look at this. With REITs, the fund itself pays zero corporate tax. And with ETFs, you, the investor, pay zero capital gains tax. This is a massive, game-changing advantage that puts way more money back in your pocket. Now, for the high-risk players out there, there's one more idea we need to touch on, the illiquidity premium. It sounds fancy, but the deal is actually pretty simple. This is for those alternative investment funds. You basically agree to lock up your money for several years in something you can't sell easily. And in exchange for that commitment, you get the potential for much, much higher returns. It's the ultimate high-risk, high-reward bargain. Okay, deep breath. We've covered the new battlefield, the contenders, how they performed, and the secret tax advantages. Now it's time to put it all together into an actionable playbook. It's all about picking the right tool for the job you need to get done. So here it is, the modern Kenyan investor's toolkit. Let's make this super simple. If your goal is high-octane growth and you can stomach the risk and the taxes, direct stocks are your play. If what you want is stable, tax-friendly income, I-REITs are the hands-down winner. For tax-free growth and an easy way to diversify globally, ETFs are the smartest, most efficient tool in the box. And if you're a sophisticated long-term investor, AIFs can give you access to the huge potential returns in private markets. The Kenyan investment landscape has totally evolved. It's not about just picking a few stocks anymore. It's about building a smarter, more strategic portfolio with the right tools for your specific goals. We've laid out the rules, the players, and the strategies. Now you know the plays, so the only question left is, which one will you run?